Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about the announcement by the Chinese authorities that they're injecting 500 billion Chinese yuan, which is the equivalent of around 69 billion US dollars, into the four largest banks in order to protect their Tier 1 capital. And we'll go on to talk about what Tier 1 capital is in a moment and why it's so important for these banks and why the injection tells us that that capital is currently being eroded because of the rising level of bad debts and falling margins in the Chinese market. And all of this is really bad news and tells us that there are underlying problems that are still going on in China, and the authorities are issuing more debt in order to try to support the banks. So the way that they're funding this cash injection is through the issuance of special purpose bonds. So the government's taking on more debt to give it to the banks so that they can bail out all of the bad loans that are going wrong. So let's talk about what Tier 1 capital exactly is. Tier 1 capital is an amount of money that banks need to hold aside to cover unexpected losses. So if I give you an example, if a regulator says to a bank that it has a large amount of risky loans, let's say it's $100 billion, and it sets a Tier 1 capital ratio of 12%, that bank would need to set aside $12 billion. Now, in the event that it did incur losses, let's say that bank incurred losses of $10 billion on that $100 billion portfolio, it's got $12 billion set aside, so it can absorb that loss and it would still have $2 billion left over. However, if that bank incurred losses of $20 billion against that $12 billion Tier 1 ratio, it would have a shortfall of $8 billion and therefore would be potentially insolvent. And that's what happened to a lot of banks during the global financial crisis back in 2008. Their Tier 1 capital ratios weren't sufficient to be able to pay for all of the losses that they were incurring. Lots of banks became insolvent and had to be bailed out. And that's essentially what the Chinese authorities are worried about happening right now. If you're a regular viewer of the channel, you'll be perfectly aware that the Chinese economy has been struggling for the past 5 years. And as you can see from this graphic, one of the reasons why the economy has been struggling is that GDP growth has been declining since 2007. In the first part of this century, GDP growth was on the rise and hit a peak of more than 14% in 2007. However, the days of double-digit growth in GDP ended in 2010. And the most recent figures for 2024 show that GDP increased by 5%. And that was actually a really good outcome because throughout the whole of 2024, it looked very unlikely that China was going to hit that figure. Now, one of the main reasons why the economy has slowed down so much over the course of the last 5 years is because of what's been happening in the property sector. Prior to 2020, things were on the rise. Literally, there were high-rise buildings growing up all across China, and people couldn't get enough of property investment. They were literally putting their life savings into new build properties before they'd even been constructed. However, after the government introduced the 3 red lines policy, which restricted the amount of debt that property developers were able to access, that caused a complete stop to the market, and since that time we've seen falling prices and a falling market, and this has led to a complete disaster across the whole of the property sector. And lots of major property investment companies and property building companies have gone bust. Evergrande was probably the most famous. That was the one that I made a lot of videos about that you may have seen over the past few years. And what this has caused is complete loss of confidence within Chinese consumers. They no longer want to invest into property, and that's led to falling prices, deflation in the economy, and lots of businesses are now making losses in China. And as a result of that, they're now defaulting on the debt that they took on from the banks over the course of the last 20 years. This chart shows the average margin that Chinese banks have been earning on loans dating back to 2015. And what you can see here is a very significant downward trend. Back in 2015, banks on average were earning a profit margin of 2.2%. However, by 2023, that margin had fallen to 1.5%. Now, we don't have the official data yet for 2024, but given what's going on in the economy and the trend that we're seeing here, it's likely that the margin has fallen further and is now less than 1.5%. And the problem with that is that it means that you don't have any headroom in terms of making losses. If you're only earning 1.5% on your loans, that means that you could only afford at the very maximum to lose 1.5% of all of the debt that you're lending out. This chart shows the percentage of non-performing loans on Chinese banks' balance sheets dating back to 2015, and what you can see here is the opposite trend to what we just looked at in terms of margins. We've got a significant rise in non-performing loans. Back in 2015, the percentage of non-performing loans was 1.5%, and just as a reminder, banks at that point were earning 2.2% margin, so there is a 0.7% profit between those two figures. However, as you can see, the level of non-performing loans has increased in every single year since 2015, and the latest figures for 2023 show that non-performing loans now represent 2.8% of all of the Chinese banks' loans. And the problem with that is that the banks are only earning a 1.5% margin on all of their debt, which means that the banks are no longer earning enough interest to cover their losses, and that means that they are banking actual losses. They are no longer profit making. This chart shows the Tier 1 capital ratio for Chinese banks between 2019 and 2023. And again, what you can see here is a clear downward trend. In 2019, on average, Chinese banks were holding 12.4% of their capital as Tier 1 capital. And as we discussed earlier, that's basically the safety net to cover any future losses. However, in view of the fact that the Chinese banks have been incurring losses and therefore have been using their Tier 1 capital to cover those losses, the ratio has been falling, and the most recent data for 2023 shows that the ratio has fallen below 11.8%. And this is one of the reasons why the Chinese authorities are now injecting 500 billion Chinese yuan into the top 4 banks to try to restore their Tier 1 capital. Can you name the 4 largest banks in China by assets? This chart shows the top 10 banks in China measured by assets, and the scale on the left-hand side of this chart is shown in trillions of US dollars. And what this shows is that the largest bank in China is Industrial and Commercial Bank of China, with assets of $6.2 trillion, followed by China Construction Bank, with assets of 5.5 trillion, Agricultural Bank of China, with 5.4 trillion, and Bank of China, with 4.9. So I'm guessing that if you made a guess, you might have guessed the Bank of China because it's probably the most famous and easiest to remember. Maybe you didn't get the other ones, or maybe you did. If you did, then congratulations. And I think the point to note about this chart is just how large those 4 banks are in comparison to the rest of the banks in China. And these other banks are obviously still significant. You can see that the Postal Savings Bank has assets of 2.2 trillion US dollars. That is a large bank. But the 4 biggest banks actually account for around 60% of all of the loans. So these are absolutely huge. And this is the reason why the Chinese authorities are prioritizing these 4 banks, because if one of these gets into financial difficulty, if it becomes insolvent because its Tier 1 capital isn't large enough to cover the potential losses, then we could see a banking meltdown in China. And in order to highlight the risk of one of these banks getting into financial difficulty, this chart shows the exposure that those 4 banks have to their top 10 assets. So basically their top 10 biggest loans. And as you can see, the biggest bank in China has a 24% exposure. So if those top 10 companies were to become insolvent, so if they were all of the property developers, for example, the bank would be looking at a potential write-off of $1.5 trillion. And the same applies to the other 3 banks as well. They've all got exposure of around 20% of all of their loans to their top 10 borrowers. So if those borrowers are in the property sector, there is going to be some serious trouble for these banks. And I think that's one of the fundamental reasons why the Chinese authorities have stepped in and injected all of this capital. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in the banking sector in particular in China is really quite fascinating, because the Chinese authorities have been fueling the economy over the course of the last 25 years or so through debt. So they're allowing lots of the large banks to have capital and give that capital out to lots of different companies and businesses in China. And that's enabled those businesses to go out and grow and therefore employ people. And you see a nice circulation of capital. But a lot of that money went to the property sector, and we've talked about this a lot. There were huge property development companies constructing cities all across China, and they were doing that through debt predominantly. They were able to source low-cost debt in huge volumes from the Chinese banks. And in conjunction with that debt, they also took lots of money from private investors in China who were paying in advance for these properties that hadn't actually been built. Now, unfortunately for those companies, the Chinese authorities put a stop to the growth of that market around 4 or 5 years ago, and that's resulted in the failure of lots of different property development companies. And the failure of those businesses is now starting to impact on the Chinese banks because obviously they were the ones that provided all of this debt. Now, we have seen some horse trading. The Chinese authorities have allowed certain businesses to be acquired by others. There are some state-owned property developers that are still being funded directly from the Chinese authorities. So some of the property sector is still doing okay. But fundamentally, demand has evaporated. Chinese consumers have lost confidence in the market, prices have been falling, and demand for property is at an all-time low. So it's fundamentally damaged the whole sector, and it's therefore unlikely that the Chinese banks are ever going to be repaid. We've got lots of bonds and loans in the market that aren't due for repayment at the moment, but when they do come up, either they'll have to be renewed for another 5 or 10 years, just kick the can down the road, or the companies will be declared insolvent. And I think the Chinese authorities are aware of this. They know that the banks have these huge exposures on their balance sheet, and so they're now giving them capital to try to protect them. But the problem with it is that they're using debt to fund that. So this isn't coming from a large cash pool that the Chinese authorities are sitting on that they don't know what to do with. What they're doing is actually issuing 500 billion yuan's worth of special purpose bonds. And that equates to around 17% of all of the special purpose bonds that China have issued. So this is a material amount of debt that the Chinese authorities are taking on. So basically what we're seeing here is the Chinese authorities moving the problem from left pocket to right pocket. They're giving the Chinese banks some capital to make sure that they remain solvent, but the way that they're doing that is by creating more debt. So the debt still exists, it's just moving around and becoming a slightly different form. So the risk becomes Chinese government risk rather than individual bank risk. But fundamentally, somebody is going to have to pay that debt back because it's just leverage upon leverage. And the whole point of this video was just to highlight the fact that although you're seeing GDP growth increasing in China, they set a target of 5% for 2025, which was the same as 24 and 23. So it looks like the Chinese economy is growing and doing well. How it's actually achieving that is still through a lot of debt, and the debt that's already out there is unlikely to be repaid, and the banks are seeing a rise in non-performing loans and bad debts. They're seeing a fall in their margins, which means that they're making less profit. So that means that they have less headroom to cover any future losses. And all of this is leading to a situation where the banks are potentially heading for some sort of credit default wall at some point in the near future. And the Chinese authorities are trying to avoid that by pumping more capital in. But as I've just said, the way that they're doing that is by issuing more debt. So this is debt on debt on debt. So the overall summary of today's video is that what we're seeing right now in the Chinese banking market tells us that there are fundamental problems in the Chinese economy. The 4 biggest banks are seeing an increase in their non-performing loans, a reduction in their income, and that's resulted in an increase in risk in China, and there is a real potential that we could see some serious defaults coming at some point in the near future. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up and subscribe if you haven't done so already. And thanks very much to everybody that's supporting me. If you've sent me a YouTube super thanks or bought me a coffee, thank you so much. Really appreciate that generosity. And if you've signed up as a long-term supporter, either through Patreon or YouTube membership, that support really helps to keep me going, keeps me motivated and helps me to post as many videos as I can. So thank you so much for that. And here's something to put a smile on everybody's face.